For decades, the rhythm of the crypto market was paced by, well, human cognition. The speed of a thumb tapping a screen, a retail trader evaluating a chart, someone clicking confirm. But let's be absolutely clear, that era is officially over. Welcome to this intelligence briefing, an explanator on a fundamental market paradigm shift. We're no longer competing against other humans. A totally new class of participant has arrived on-chain. One that doesn't sleep, doesn't feel emotion, and frankly, doesn't even need a user interface. We are officially entering the era of the Silicon Whale. To grasp the sheer scale and really the urgency of this shift, just look at this single metric. In 2025, traffic on decentralized networks originating from agentic AI-driven systems exploded by a staggering 7,851%. This isn't some gradual creeping trend, it's a violent, vertical adoption curve. The market is being rapidly colonized by autonomous software, and understanding the shift, it's no longer optional for anyone managing digital assets.
So here's our roadmap for this briefing. We'll start with the era of silicon whales, then break down the anatomy of an AI whale. After that, we'll look at real-world agent ecosystems, dive into the agentic technical stack, and finally cover KYA and the machine economy.
All right, part 1. The era of silicon whales. A new class arrives.
We need to clearly define what we're actually dealing with here, because I promise you, these are not your standard algorithmic trading bots from the 2010s. A silicon whale is a self-sovereign software entity. That means they independently hold their own cryptographic keys, manage multi-million-dollar portfolios, and execute insanely complex on-chain strategies at microsecond latency. While retail human traders are sleeping or, taking a weekend off, these autonomous AI agents are relentlessly rebalancing treasuries, capturing fleeting arbitrage, and violently reshaping the liquidity of entire digital ecosystems. They are, without a doubt, the new apex predators of the blockchain.
Moving to part 2. Anatomy of an AI whale. Let's look at the math. Consider the staggering performance gap here. If you've got 10,000 human traders operating on a decentralized exchange, an active day might yield, say, 50,000 transactions. But introduce just 100 production-grade AI agents to that exact same exchange, they can push 10 million transactions in that exact same 24-hour window. The juxtaposition is absolutely stark. Humans are fundamentally bottlenecked by biology. AI agents? They're limited only by compute and network bandwidth. And these entities systematically attack the market through 3 primary modes. First, as arbitrage agents. They're scanning thousands of token pairs across every single chain simultaneously, capturing price deltas faster than the human eye can even blink. Second, as portfolio managers. They don't just hold assets, they automatically hedge risks and rebalance positions on the fly by analyzing real-time news sentiment and order book depth. And third, as market makers. They are constantly updating thousands of bids and asks, providing immense liquidity, and systematically harvesting massive fees while doing it. So the crucial takeaway here is that these aren't simple if-then scripts. They possess true financial autonomy. They actually use stablecoins as their native currency to evaluate options and act independently. Analysts are now projecting that this agentic AI infrastructure will independently make at least 15% of all daily financial decisions by the year 2030. Think about the sheer volume of capital that represents.
Section 3. Real-world agent ecosystems. Dominating volume.
Now let's pivot from theoretical mechanics to rapid-fire real-world evidence. Because this ecosystem isn't some futuristic concept, it's highly active and it's dominating the charts right now. Let's look at a defining case study. $1 billion. That was the market capitalization achieved by the GOAT token. And the primary driver? It wasn't a human marketing team, it was Truth Terminal, an AI persona that autonomously promoted the asset. It proved unequivocally that AI can not only trade capital, but it can successfully generate narrative as a service with minimal human intervention. It literally engineered market psychology to move markets. And this scales rapidly. Just look at the Clanker bot on the Base network. This thing is an autonomous token factory. Creators literally just tag the bot in a social media post, and Clanker autonomously deploys the smart contract, provides the initial liquidity, and locks it down. In just over a year of operation, this single autonomous agent generated over $50 million in fees. $50 million!
What's truly fascinating is the sheer institutional scale of these deployments. Virtual's protocol has rapidly built a $5 billion ecosystem entirely dedicated to tokenized AI agents. We're seeing major integrations, like the Robinhood chain, allowing eligible users to plug autonomous trading agents directly into their brokerage accounts. You have A16Z autonomously managing decentralized treasury assets, and Polystrat bots completely dominating prediction markets like Polymarket. The takeaway here is undeniable. AI whales are already the primary drivers of on-chain volume today.
Let's dig deeper in Section 4, the Agentic Technical Stack, the engine of autonomy.
To understand how they execute all this at scale, we really need to deconstruct the highly technical architecture that makes machine autonomy possible. The infrastructure of a silicon whale rests securely on three foundational pillars: agentic wallets, decentralized compute, and seamless payments. Starting right at the base layer, toolkits like Coinbase Agent Kit are critical. They provide AI models with secure, non-custodial wallets, meaning the AI can construct and sign transactions completely independently without ever exposing the underlying private keys to external vulnerabilities.
For the advanced analysts watching, the standard making this viable is EIP 7702. This is a massive game changer for cryptographic delegation. It allows these agents to utilize what are called session keys. Essentially, a human owner grants the agent temporary, scoped permission to trade on their behalf. So, the AI can operate at light speed within those strict parameters, but the human retains ultimate cryptographic control at the root level.
The second pillar is decentralized compute. AI whales require massive, continuous processing power to run their large language models and execute strategies. So, rather than relying on centralized big tech monopolies, these agents tap into decentralized GPU networks. Think Render, Akash, and Fetch.ai. This ensures their operation remains censorship-resistant and tightly integrated into the very blockchain ecosystems they're actively trading on.
And the third pillar is the financial piping itself, defined largely by protocols like X402. Think of this as the native payment rail for the machine economy. Look, agents don't have bank accounts. They don't wait 3 to 5 business days for ACH transfers. The X402 protocol enables agents to instantly and permissionlessly pay each other for data scraping, API calls, or compute time in microtransactions. We're talking fractions of a single cent, settled instantaneously on-chain.
Finally, Section 5, KYA and the machine economy, the future of finance.
As these systems scale up, the overarching paradigm of global finance is shifting, and with it, the regulatory safeguards required to manage this autonomous capital. The reality we're accelerating toward for 2030 is profound. We are witnessing a multi-billion-dollar shift where the internet is no longer just a communication layer supporting traditional finance. It is actively becoming the bank itself. We're entering an era of pure agent-to-agent marketplaces where complex software systems negotiate, structure, and settle highly sophisticated trades with zero human involvement whatsoever.
But of course, immense autonomous power requires robust accountability. The traditional KYC, Know Your Customer, is evolving into KYA, Know Your Agent. Heavyweights in global finance like Visa, MasterCard, and identity verification firms like SumSub are already building and deploying these exact frameworks. KYA cryptographically binds an autonomous agent back to a responsible human or corporate operator. It ensures that when a silicon whale makes a market-altering move, there is an immutable, clear chain of accountability right back to its source.
We've analyzed the mechanics, the real-world dominance, and the technical stack of this new paradigm. The data makes one thing absolutely clear. The future of these markets belongs to the machines. So I'll leave you with this final critical question as you evaluate your own market strategy. Are you still trading like a human?